As we close out the week on Friday, November 28, 2025, the world's attention is once again focused on the ever-shifting oil markets. This date marks not just the end of another trading week, but also a pivotal moment in the ongoing story of global energy prices. The global oil market is under significant pressure, with traders and analysts closely monitoring every move. Volatility has become the norm, as uncertainty about future supply and demand continues to drive rapid changes in sentiment. Crude oil prices have now fallen for the fourth straight month, marking the longest losing streak since 2023. This persistent decline is sending ripples through financial markets and raising questions about the future direction of energy costs. Brent crude's January contract settled at $63.20 per barrel, reflecting a significant drop from previous highs. This price is being watched closely by both producers and consumers, as it sets the tone for global oil benchmarks. Meanwhile, the February contract dropped even further, closing at $62.38. These back-to-back declines highlight the market's ongoing concerns about oversupply and weakening demand. In the U.S., West Texas Intermediate, or WTI, closed at $58.55 per barrel, continuing its own downward trend. American producers are feeling the squeeze as profit margins shrink and uncertainty grows. Earlier this year, Brent averaged nearly $69 per barrel, a level that now seems distant. The sharp drop since then has caught many by surprise and forced a reassessment of market expectations. The main driver behind this decline is a growing belief that global oil supply now exceeds demand. Storage tanks are filling up, and tankers are waiting longer at sea, signaling a glut in the market. When buyers see plenty of oil available, they're less willing to pay high prices. This abundance gives them leverage in negotiations and puts further downward pressure on prices. Despite some minor weekly gains and occasional price rebounds, the overall trend remains negative. Each small uptick is quickly overshadowed by broader market pessimism. Short-term news events, such as geopolitical tensions or unexpected supply disruptions, can cause brief price spikes. However, these are usually short-lived, and the long-term direction continues to point downward. The market is reacting to a complex mix of factors, including shifting geopolitical news, fresh economic data, and new production forecasts from major oil-producing nations. Each of these elements adds another layer of uncertainty. This creates a dynamic and unpredictable environment for everyone involved, from oil giants making billion-dollar decisions to everyday consumers watching prices at the pump. As we move forward, all eyes will remain on the oil market, searching for signs of stability or further turbulence ahead. The ongoing Russia-Ukraine peace talks are a major force behind daily oil price swings. Hints of a peace deal spark hopes of stable Russian supply, sending prices lower. Earlier this week, oil prices dropped sharply on reports of progress in negotiations. A peaceful resolution could ease sanctions and boost Russian exports, increasing global supply. But when talks stall, prices rebound as supply risks return. This back and forth shows how sensitive oil markets are to geopolitical headlines. Traders constantly adjust their positions based on the latest news. If talks collapse, tighter sanctions could restrict Russian exports and trigger a price spike. The market is on edge, pricing in every twist and turn. The outcome of these talks could reshape the global oil landscape overnight. Oil traders scrutinize every update from the Russia-Ukraine peace talks for clues about future supply. Hopes for peace are bearish, signaling lower prices as supply fears ease. Positive news prompts traders to sell, betting prices will fall. When negotiations stall, the risk premium returns, and prices rebound. This cycle of optimism and anxiety drives sharp price swings. The market reacts not just to events, but to expectations and rumors. Subtle changes in language or perceived progress can move prices dramatically. For now, the market is caught between hopes for peace and the reality of ongoing conflict. OPEC+, the organization of the petroleum exporting countries and its allies, including Russia, remains the most powerful force in oil. Their main goal, keep prices stable and favorable for member economies. When prices fall, OPEC+ can cut production to support the market. Their decisions impact everything from gasoline prices to shipping costs worldwide. OPEC+ meetings are closely watched, as their policy shifts can move prices in minutes. The group reviews global demand, inventories, and economic forecasts before setting production targets. No single country wields as much influence as this collective. Their actions can override other market factors. Every OPEC Plus decision sends shockwaves through the global energy market. All eyes are on the OPEC Plus meeting this Sunday, November 30th. The big question: will they cut production to halt falling prices or hold steady? Most analysts expect OPEC Plus to maintain current output, including a 2 million barrel per day cut already in place. Saudi Arabia and Russia have made additional voluntary cuts, but the group may wait to see how the market evolves. The meeting will also address how to set future production quotas, a contentious but crucial issue. 4 online meetings will take place, starting with core OPEC ministers. If OPEC Plus holds steady, it signals comfort with current prices or faith in a market rebound. A surprise cut would show determination to stop the slide. The outcome will set the tone for oil prices heading into 2026. The biggest force pushing oil prices down is a global supply surplus. The world is producing more oil than it consumes, especially with surging U.S. output. American oil, driven by advanced drilling, is flooding the market and competing with OPEC Plus barrels. This makes it harder for OPEC Plus to control prices through cuts alone. Analysts say the surplus is the main reason for the bearish outlook. Even strong demand can't lift prices much when supply is so abundant. OPEC Plus's influence is waning as non-OPEC production rises. Saudi Arabia is even cutting prices to stay competitive. Until demand catches up or non-OPEC output slows, the surplus will keep a lid on prices. The United States has surged to become the world's top oil producer, reaching an unprecedented milestone of nearly 14 million barrels per day in September 2025. This achievement marks a dramatic shift in the global energy landscape, positioning the U.S. as a dominant force in oil production. This record-breaking output is the direct result of the shale revolution, which has transformed the industry through innovative drilling techniques and relentless technological progress. Advances in horizontal drilling and hydraulic fracturing have unlocked vast reserves that were once considered unreachable. Every additional barrel produced in the U.S. adds to the global oil supply, reducing the world's reliance on OPEC Plus producers and shifting the balance of power in international markets. U.S. oil exports are climbing to new heights, sending American crude to markets across the globe and intensifying the worldwide surplus. This surge in exports is changing trade flows and challenging traditional suppliers. OPEC Plus has responded with production cuts, but these efforts are increasingly offset by America's relentless growth. The group faces mounting pressure as U.S. output continues to rise, making it harder to control prices. Many analysts once predicted the shale boom would be short-lived, but ongoing efficiency gains and cost reductions have kept U.S. production high, even when prices fall. Companies are finding new ways to do more with less, ensuring continued growth. This steady and reliable supply acts as a crucial buffer against global shocks, helping to keep fuel prices stable and preventing sudden spikes that could disrupt economies. For American consumers, this means more stable and affordable energy costs, allowing families and businesses to plan with greater confidence and spend less at the pump. But for oil-dependent nations, the U.S. oil boom presents a major challenge. These countries must now work harder to balance their budgets, manage economic uncertainty, and adapt to a market where their influence is diminished. Ultimately, the rise of U.S. oil production is reshaping the global energy landscape, redrawing trade routes, and redefining the roles of traditional energy powers in a rapidly changing world. Facing a supply glut, Saudi Arabia is expected to cut its official selling price for Asian customers for January 2026, the second consecutive month. This move signals a fight to maintain market share in a crowded field. With U.S. and Russian oil competing for Asian buyers, Saudi Arabia is offering deeper discounts. Some reports suggest prices could hit 5-year lows for Asian refiners. The price cut is a defensive move to protect sales volumes amid fierce competition. Even as OPEC Plus cuts production, individual members must compete on price. This strategy highlights the tension between supporting prices and keeping customers. Saudi Arabia's move reinforces the message. Supply is ample, and competition is intense. The future of oil prices is at a crossroads, hinging on 2 pivotal events that could reshape the global energy landscape. The upcoming OPEC Plus meeting, where the world's most influential oil producers will decide their next move, and the high-stakes Russia-Ukraine peace talks, which have the potential to dramatically alter the flow of oil supplies worldwide. If OPEC Plus chooses to maintain current output levels, the market may continue to feel downward pressure, as supply remains robust and demand growth is uncertain. However, a surprise production cut from OPEC Plus could quickly ignite a rally, sending prices sharply higher as traders scramble to adjust their positions. On the geopolitical front, a breakthrough in peace negotiations would likely pave the way for Russian oil to return to global markets, easing supply constraints and pushing prices lower. Conversely, if talks collapse or tensions escalate, renewed fears over disrupted supply could send oil prices soaring once again, adding volatility to an already uncertain market. Beyond these headline events, record-setting production from the United States and other non-OPEC countries is playing a crucial role, helping to keep a lid on prices and providing a buffer against sudden shocks. As a result, many analysts now forecast that Brent crude will average around $62 per barrel in 2026, reflecting expectations of a well-supplied market despite ongoing uncertainties. Investors and traders are closely monitoring every signal from OPEC+, as well as the latest updates from the ongoing peace talks, knowing that any development could trigger swift market reactions. Meanwhile, weekly U.S. production and inventory data continue to shape market sentiment, offering clues about the balance between supply and demand. For now, the overall mood remains bearish, with abundant supply and high inventories weighing heavily on prices and keeping traders cautious. The big question now is whether the upcoming OPEC Plus decisions or a breakthrough in peace talks will be enough to shift the market's direction, or if the current trends will persist. As 2026 approaches, the next chapter for oil prices will be written by the choices made in the days ahead, with every headline and decision carrying the potential to reshape the market's future.